So today I've got 5 big stock updates for you guys. Some of the stocks I own, some stocks I don't own, but the stocks I do own, wow, some of them came out with some impressive numbers last night and some really good earnings updates, and they're making some really good moves today. So I hope you enjoy the video. Another busy day in earnings season. Let's get started. Now the first one is the King. The King reported its earnings, and normally I would do a full breakdown of their earnings on the YouTube channel. That's what I've done for like the last 2 or 3 years now, but I'm not going to do it this time round. I'm going to stop doing it on the YouTube channel. I just don't know if there was that much interest there. I think that a lot of you guys that come to the YouTube channel want quick, short form content on a stock, like 3 or 4 minutes, not a big deep dive. But for you guys that do want a big deep dive, I am going to do a dedicated deep dive into the DraftKings earnings on Patreon, so you can join that, and I'll do that for you guys on the weekend, as well as a big earnings review overall. So I'm going to move that video to the Patreon for you guys that want a really big nerdy deep dive into some of the numbers, because there were some really good numbers deep down in that earnings report. But if you're not nerdy, I'll do a quick 2 or 3 minutes review of the earnings, and yeah, really good. Now the conference call still has to go on. I have obviously not listened to that yet. Hopefully Jason Parks, Jason Robbins, really good talkers. They give a lot of good information out in the conference call, so maybe that moves the share price a little bit more when that does start. But the stock is up around about 1% in pre-market. Now you might be saying, well Jacob, you're saying that these DraftKings numbers were absolutely amazing, but the stock is only up 1%. Yeah, that's true, but you've got to remember, guys, we're up 28% year to date. We are crushing the S&P 500. In the last year, we're up 96% in the last year alone. We have to have a cooling off phase, guys. Like, it's going really well for DraftKings, but let's face it, we're back at trading at a bit of a more premium valuation now. So we don't want to get too stretched. It'd be good for the financials to move a bit more in the right direction to catch up to that share price. So don't get too greedy, don't get carried away. But what is more important is the actual financials. And the financials, wow, once again, I think DraftKings has been the best company in earnings season that's reported for like the last 2 or 3 years now. They just constantly smash their earnings. And for me, when I have got this position as my largest position in the stock market, obviously, yeah, I'm absolutely buzzing. Non-GAAP EPS was a beat. They beat by 0.14, which is absolutely amazing. And from a revenue point of view, they grew 53% year over year. So this isn't with even that many new states coming online. They still grew at 53%. They don't even need the new states, guys. They don't. If the new states come online, that's just a bonus. You know, the iGaming ramp up, it's just a bonus. If more sports betting states come online, that's just a bonus. The actual core business has still so much growth with the states they currently have as well. And just to top it off, they came in with a triple beat. They raised the guidance once again on the revenue point of view, and you can see here the midpoint of the adjusted EBITDA guidance as well was raised as well, which is absolutely insane. So a triple beat, and they're really focusing on the profitability now, which is really good. And like I said, there was a lot of standout numbers that I could use in this earnings report, and I am going to go a little bit more detailed into this more earnings report on the Patreon for you guys. There was so many good numbers in here, with like the average revenue that was being spent on the platform was amazing. The stock-based compensation was down once again. The sales and marketing costs were being managed really well. It was so impressive. But the big thing that impressed me this quarter wasn't even really DraftKings. It was another company, and the other company was Penn National. Penn National is down massive after it reported its earnings, and the big reason why this is a big positive for DraftKings is because they released probably the biggest rival into this space in the last couple of months. They launched ESPN Bet. Disney, that has had ties with DraftKings, kind of went, you know what, we're going to sell off our platform to ESPN, and we're going to, our ESPN platform, and we're going to partner with Penn National and launch ESPN Bet. And ESPN Bet was launched on the 14th of November 2023. And I was a little bit like, oh, this could be a little bit competitive for DraftKings. Are they going to take some of the market share away from them? No. Penn National, if you look at their earnings, massive EPS miss. They put this down to the costs of the launch of the ESPN Bet. Basically, in my opinion, I think they've gone, oh, we spent all this money and we thought we were going to get rewarded, and we haven't. The revenue, I mean, imagine launching something like ESPN Bet, and then your revenue goes down 3% year over year. Mega poor results from Penn National. And what that says to me is the big worry around ESPN Bet, and that's going to come for DraftKings. Nope. DraftKings shoved it off and went, nope, they're not taking market share off us. And all them sort of people that said DraftKings doesn't have a moat, it's just about who can offer the best marketing, bets or the free bets, well, once again, DraftKings shoved off ESPN Bet, they shoved off Penn National, they shoved off Disney and went, we're taking market share, we're controlling our market share. The best product wins, and DraftKings has the best product. They have a monopoly, a duopoly over the US online gaming space, absolute online gambling space and iGaming space, and they're absolutely smashing it. They're so impressive, so impressive. This is the most happy I've been with DraftKings ever. It's only getting more and more bullish for me. The fact that they've been able to knock off ESPN Bet now shows to me the moat they have is a moat. And that's what a lot of people said they would never have, and they do. So really impressive numbers. It might not be getting the share price reaction today, guys, but we've got it previously, and if it stays like this, we'll get it in the next 2, 3, 4, 5 years. So don't worry too much about the reaction on the share price today. Mercado Libre. So Mercado Libre was up 4.5%, and realistically, there was me there on the last earnings drop, and I was thinking, you know what, maybe I should have bought a few more shares on the last earnings drop, or even in the last few weeks, and it started to have a bit of a rally out now, and maybe I should have bought a little bit more in Mercado Libre, but hey, I've still got plenty of shares in there, and I'm happy. I did buy some, I just didn't buy enough really, and so impressive numbers. I mean, the EPS came in with a beat, you can see a $6.78 beat. Look at this beat, 0.83 beat. That is, that's insane. That is crazy. Revenue growth of 35, beat by, they grew 35%, but it gets better than that when I want to show you in a second. Beat by 460 million. That's on 4.3 billion, by the way. That's crazy. And there was a lot of people, I made a video talking about Mercado Libre being, in my opinion, still very cheap. And people going, but it's 77 times earnings. It's not cheap. And people got really offended when I said Mercado Libre is cheap. Well, obviously, the share price is having a good reaction at the moment. But when you're a company that's beating your EPS by this much, when you're a company that's growing 35% year over year and beat by this much, and because the profitability is ramping up so much, the company is now trading at 46 times forward earnings, and it's probably going to be even lower because of how much they're beating the EPS by. So realistically, this company is going to be probably towards 30 times forward earnings. 30 times forward earnings for a company growing at 35% is good value, guys. It's good value. You got to remember, you're paying up for the future growth. And if you are going to grow at 30+% a year, that valuation comes very cheap very quickly. And that's what you do as an investor. You're trying to think about where it's going to be in the future. And sure, it might look expensive if you're buying the stock right now, but how quickly the Mercado Libre will grow into that valuation makes it very cheap. And it gets even better. The net revenues, as we said, grew 35%? The actual report says 36%. 36%. But look on the FX neutral basis. There's obviously a lot weaker currencies in the likes of Latin America at the moment, and it's hurting them a little bit. But even with the weak currencies at the moment, on an FX neutral basis, they would have grown 94%. 94%. I mean, if the currency neutralizes, and the impacts that we're seeing with like the Argentina currency at the moment, if that neutralizes, I mean, we talk about it being cheap, growing at 36% year over year. Imagine if they do neutralize this currency and it's growing 60, 50%, 60%, 7% a year. It's absolutely insane. And what also impressed me is that obviously, Mercado Libre don't guide for the next quarter. They always just put out the numbers. So this is why Mercado Libre always come with these big beats, because analysts are always guessing, and they surprise them all the time. That's why they're always so consistently good on beating the numbers. Is that, do you remember last quarter, everyone panicked because the net income went negative because of the one-time charge, and everyone was like, oh, that's it. And then boom, we have the best net income percentage that's ever happened with the business. It's just so impressive, guys. I love this company. Love this company. Block was up 7%, so another one of my stocks having a really good move in the pre-market, and it was at one point, I think it was actually up a little bit more when the numbers did come out. Block, I'm not going to lie, I actually bought this week. I actually bought going into these earnings, which is really risky. I don't normally do it, but I looked at the numbers that they were forecasting, and I was like, wow, this is a really good forecast. And I was re-listening to Block's last earnings. I was like, they're actually really focused on profitability here. And once again, that really came through. If you look on the GAAP EPS basis, it beat by 0.12. The growth, this is the best growth that Block have put in for a long time. 19% year over year growth. And the thing is, this company's traded at 20 times forward earnings. this is really good numbers for a company that's really focused on profitability and growing at 19%. These are the best numbers I've seen Block do for a long time. Apple's actually up 6% in pre-market. I think this will probably lift the market overall as a whole, but I got to say, this is shocking. Apple should not have been up today. It should not be up. The numbers that I've seen Apple do are the worst numbers I've ever seen Apple do. The fact that it's up is disgusting. It's disgusting. I mean, look at this, okay? So, yeah, EPS beat. Oh, okay. Revenue, yeah, it beat by 190 million. But look at this. 4.3% revenue decline. They're struggling for growth. And this isn't like it's just happened with Apple. They had a bad quarter last year. So the fact that they're now, once again, doing another bad quarter, this is a big issue. This is a big issue for Apple, that they're struggling. They're really struggling as a business, and the growth has basically gone out of the company. They're not growing on the profitability, they're not growing on the revenue point of view, and they can cover it up and go, yeah, they beat on EPS, they beat on revenue, but sorry guys, as a successful business, you need to have profit growth and revenue growth, and they're stuck. You look at Apple, what have they got? The main product is an iPhone, and yeah, they can always bring out some new models, they can always increase the prices, but eventually they have to reinvent themselves. I mean, imagine the day if there's actually another company that brings out a phone product that actually does take even 20% of the market share from Apple. They'll be absolutely screwed, but they're just not reinventing themselves. Now, the only reason why the stock is up today is because they announced a bigger dividend, and they're buying a big ton of shares buyback. They're buying 110 billion of the company's stock, which I think is something like 4% of the market cap. I mean, that's a major buyback, to be fair to them, 110 billion, but 4% of the market cap is not much when you're a 2.6 trillion market cap company. And let's be realistic, the problem with Apple is they've not invented any new products. That's the reason why they're stuck. They've got no new products. And everyone knows as a big business, right, you have to reinvent yourself. If you don't reinvent yourself, you're going to lose out to the smaller companies, and then they come up, and it's their turn to be in the limelight. But if you look at the likes of Amazon, they keep reinventing themselves. They brought out the Amazon Web Services, they bring out the cloud, they're now investing into AI. Look at Microsoft. They keep reinventing themselves. They're buying Activision, they're going out and doing the cloud, they're doing the AI. If you look at all the big tech companies, Google, investing into the cloud network, now investing into the cloud, the AI network. Apple have just stood still for so long. They didn't get involved in the cloud space, they missed that, or they didn't get involved in something like the cybersecurity. They're not getting involved in the AI, or they're majorly behind in the AI space. I think they are working on a few things in the background, but once again, they're miles behind. They're just miles behind. They're just so slow to reinvent themselves. So everyone knows, right, if you can't keep on top of the growth, you go out and buy a competitor. Now, rather than spending 110 billion buying back stock, which okay is a short term, is a plaster on the big gash that's coming up more and more, you've got to, if you can't make the businesses yourself, you go buy the businesses. You go out and you buy an AI play. You go out and you buy a social network. You go buy Pinterest. You expand into the payment sector. You go buy a PayPal. 110 billion goes buys your PayPal. You go out there and you buy a Shopify and you get into the e-commerce space. You go and do it. You go and buy the acquisitions, and you go that way to do the growth. That's something like Microsoft. They've reinvented themselves, but at the same time they've also made acquisitions along the line, like Activision, for example. And Apple have just stood still. And I think the management are really poor at the moment. And the only way they have to solving this issue at the moment is dividends and share buybacks. But do you know what cost that's kind of come to? Look at the balance sheet, guys. Look at the balance sheet. Apple used to have one of the best balance sheets in the world. And slowly, look at the debt that's loaded up. The debt that's been loaded up, not because of acquisitions. It could have been used for acquisitions. And that acquisitions could have diversified the company's revenue, drove up profitability, drove up revenue. I mean, imagine if they went and bought Pinterest 3-4 years ago. Imagine if they went and gone and bought someone like a Dropbox 3 or 4 years ago. And they haven't. They've just used it for share buyback. And it's a short-term solver for the issue, but long-term, I mean, look at the balance sheet now, guys. 108 billion in debt. And the thing is as well, is the cash pile. The cash pile's even suffering right now as well. I mean, to be fair, they've still got a lot of cash on the balance sheet, but it's still not as good as what it was. And the thing is that I look at Apple and go, what will they do in the long term? And I don't know. And the thing is, as well for this one, guys, is that you're paying up a 26 forward times earnings. A 26 forward times earnings for a company that's struggling to grow growth. Revenue's declining. It's horrible to me. I am still shocked that, I guess really now that it has continued to perform pretty well, and it's finally starting to have a bit of a reality check, but I'm still surprised that Apple is down only 9%, and it still trades at 26 times earnings. Like, you stick every other company, right? Any other company that did these numbers, Tesla, something like an Intel, for example. I mean, look at InMode. I mean, InMode did a share buyback, and look at how that stock's been treated. Any other company that did these numbers, I think would have been down mega year to date. But yet you've got Apple that's down 6%. It's crazy. I think they're in a big mess, guys. Big mess, and I'm still shocked at how the share price has held up this long. And the last one is Fortinet. So it's a week today that Darktrace actually got bought out. And it's crazy how fast a week goes. And obviously, really happy. This joined the 100% club, made a lot of money on it. And obviously really buzzing. The only little thing that I've always been sad about is that I always thought this was going to be a longer term hold. And now that this is gone, I'm looking for a cybersecurity play to replace it. And I'm scanning out there. I'm keeping an eye on a few earnings. And I looked at Fortinet last night that brought out their earnings. And this trades at 44 times earnings. Darktrace, which by the way has had a recent bump up only in the last 1 month, and the buyout news on top, is currently 44 times earnings. Before this company was 30 something times earnings. So on an earnings basis, Fortinet and Darktrace are exactly the same. And like I said, that's adding in that Darktrace has only just had this major bump up with the acquisition and everything like that. So it was a lot lower. And I was looking at Darktrace, and Darktrace's numbers I was so impressed with in the recent update. You look at the revenue, it's growing 27%, they're going to grow 20% a year. I mean, the profitability is really ramping up. And I'm trying to look for someone, to replace them as a cybersecurity play. And I thought, I'm going to check out these guys' earnings. And they're down 7% in pre-market. And obviously, like I said, 44 times earnings. And then I looked at the numbers and I went, revenue growth, 7.1%. To be a replacement of Darktrace was going to grow 20+%. And yet I would have to pay up the same valuation for a company that had a third of Darktrace's growth. And from a profitability point of view, the profitability weren't ramping up as well, either, as fast. And it frustrated me a little bit last night because I looked at Darktrace and I was like, it was good and all that. We made good money on it, good profit and all that. But I do look at Darktrace and I just think, I'm absolutely devastated that it got sold out, because I do think that this would have done really well, and I still think the valuation was mega undervalued. And it just shows you that I'm trying to look for a similar company, but you can't pay up 44 times earnings or 38 times forward earnings for a company that's growing 7% year over year. And I think the guidance was also a little bit weak as well, and I think that's why the stock's dropping here. But it's just, for 38 forward times earnings and 7% growth, I can go buy PayPal at 16 times earnings. It's over half the valuation. I'm sorry, but if you're that sort of level, you've got to be growing 20+% year over year. So yeah, I just thought I'd point that out because the more I look at Darktrace, I do get annoyed at that one, and the thing is that I do try to look at another company that could potentially fill the cybersecurity gap that's down in the portfolio, but I just can't find anything at attractive valuation at the moment. And for a company like this, I would expect to be paying up 14 times forward earnings. It's crazy. So yeah, I thought I'd just mention that as something that's that I'm doing in the background. I don't think there was really much point to it. Well, I guess the point was that I believe Darktrace was just ridiculously undervalued, and I think even now when it's bought out, I think it's ridiculously undervalued. But also trying to find a replacement, it's really hard to find something out there to replace it at the moment, and that's something that I looked at last night, and I was like, this is potentially something that maybe could go in there, but just look at the difference there between the quality of the businesses and the valuation. It's crazy. So yeah, overall, that's the review of earnings, guys. DraftKings, we've got Mercado, Libre, Block, Apple, and Fortinet. Obviously on the Patreon, I'll do a bigger deep dive, as I normally do, the big nerdy deep dive on the Patreon of DraftKings earnings. So if you want a bit more of what's going on with the numbers and a little more detailed numbers, I'll drop that for you guys, and then I'll do a separate big earnings review because I think the DraftKings one will be at least 20 minutes, and then obviously the earnings review will probably be another 20 minutes. So I'll split them up for you guys as well on the Patreon. And yeah, I might get a few more videos to you on the YouTube over the weekend. We'll see what happens. It's been a busy week. I'll see how much time I have. But yeah, thanks for watching, guys. Hit that like button. Have a great weekend. See you in a bit.